Hello, I'm Jay Hirsch, Director of Administration of Columbia's ERM program. I'd like to welcome you to today's event, CRO Spotlight Series featuring Mandy Norton of Wells Fargo. Throughout the event, you may post any questions you have using the Q&A feature at the bottom of the screen. Questions will be answered at the end of the event. I'd like to tell you about some upcoming events we have planned. We have two more mindfulness seminars this semester. On Fridays, we have our coding seminars. On Saturdays, we have our IQRM seminars. We have two more coffee and conversation networking events. And on April 1, we have our featured alumni series panel. And now I'd like to introduce today's host, Sim Segal, founder and director of the ERM program at Columbia University and president of Symergy, an ERM consulting firm. Sim?
Thank you, Jay. We're proud to bring you today's events and welcome everyone. This is another edition of our new CRO Spotlight series, which features one-on-one interviews with leading chief risk officers. Bob Kostakopoulos, Deputy Academic Director and Lecturer, will introduce our featured CRO and serve as moderator for today's event. Bob is an expert in regulatory frameworks and enterprise risk management, and he formerly served as President, CEO, and Director of 3 different community banks, and he also served as Head of Quant Research at Merrill Lynch Economics. Bob has a PhD in Econ from Columbia University. Bob?
Thank you, Sim. Greetings to one and all. As you know, panels are an important co-curricular activity in the ERM program. Just for today's CRO Spotlight series, I'd like to mention that the Financial Stability Board issued its guidance some time ago on the principles of an effective risk appetite framework. Principle 4, Roles and Responsibilities, establishes the CRO function as a key executive function. So this is the context of today's panel. As Sim mentioned, today's panel, the CRO Spotlight Series, features Mandy Norton, Senior Executive Vice President and Chief Risk Officer of Wells Fargo, a global systemically important bank, a GSIB. Recently, by the way, Wells Fargo celebrated its 169th birthday, March 18th, 1852. I'm very happy to have this opportunity to interact with Mandy on issues that are important to our students in the ERM program and to the profession at large. Welcome, Mandy.
Thank you, and thank you for the opportunity. It's great to be here.
Thank you. Thank you for being here. I would like to start by noting that you have a sterling career in banking and financial services. Could you be so kind as to share with our students the highlights of your outstanding career?
Well, thank you. I appreciate that introduction, and I did not know actually Wells Fargo celebrated that birthday, so that's great too. So yeah, I've had a very fortunate career. I actually started my career in a risk management discipline, actually in the market risk space, back in the early 90s, let's just say that, when market risk was still developing and maturing and evolving. And I found when I look back at my career, what a wonderful opportunity to be part of something that was really evolving, and we were still learning. We were still, you know, the regulators really hadn't got their arms around it. So it was really driving that forward. And I found myself in a couple of different positions where we were really building a lot of the new risk metrics and the reporting and thinking about what it meant. So those sorts of opportunities have been sort of peppered throughout my career and really been wonderful ways in which to learn and grow. But I have had the also great opportunity to work in a number of different cities and a number of different countries, including Asia and of course the US. I'm British, but I've been living in the US now for 23 years, and you know, but spend a lot of time in Asia, spend a lot of time in Europe, and now of course the US. And so those have been, you know, really great opportunities to work for different companies in different cultures in different roles. I would say probably 2/3 of my career have been in risk management type roles. As I mentioned before, I started in market risk, and later in my career, I moved more into the credit risk, and then more into this role and idea of enterprise risk management. And of course, now CROs are exactly that. But I did spend about 7 or 8 years, actually probably closer to 10 years, in a couple different, what I would describe more frontline roles. And I actually was an investment manager in the corporate investment portfolios for a large bank for about 6 years. So traded and managed the portfolio, and that was pre-Volcker. So there was you know, a lot less regulated, and you know, spent a lot of time actually running proprietary trading books and things like that, which was a wonderful experience. You learn a lot about yourself when you own a P&L. I also spent some time in a treasury function too, which really gave me the nuts and bolts of how a bank really operates, makes money, what the risks are, capital, liquidity, forecasting, all those kinds of things. And again, I think it was a really important time and experience for me. I think I'm a better chief risk officer today for those experiences, and having worked in a frontline group, owned a P&L, as I call it. And I think that just brings a, you know, sort of broader set of experiences to the chief risk officer role. So really quite a journey, none of it planned, but had some wonderful opportunities. And you know, as many of you, I'm sure, have studied even, you know, managing through the financial crisis of 2008, 9, and 10. And then, of course, the last couple of years, best times to learn, best ways to, in which to really evolve as a person, as a manager, as a leader. And, you know, this won't be the last set of experiences. I'm sure you all have similar ones, but, you know, really embracing those kinds of experiences has been very helpful in my career. And now I'm a US citizen as well as a British citizen. So.
Oh, that's great. That's great. Well, that's a wonderful trajectory. And I'm sure our students are taking note that the career path is never linear.
Never.
And of course, in your capacity now, all sources of key risks are in the purview of your responsibilities.
Right.
And the experiences, the global experiences, as well as the frontline experiences, all inform your the way you approach your CRO function at the present time.
Yes, exactly right.
Great. It's great. In terms of risk programs and standards, can you describe the structure of your risk governance? What is the board's role in ERM, for example? What type of information do they want to see, the frequency and the level of engagement?
Yes, and it's a great question, and quite frankly, I think it's still evolving, but certainly something that has become a key focus for large banks, for the financial industries, and for the regulators, particularly after the last crisis. And I think we all managed credit risk generally, although, you know, a lot of the credit losses were really around the key assumptions. But I think, yes, you made a good point earlier. The CRO's purview is really across all the risks. So it's all the financial risks like credit, market, liquidity, interest rate risk, and all of the non-financial risks, which we put it under a broad umbrella of operational risk, but includes compliance, model risk, technology risk, conduct, all of those things. And, you know, and I think that continues, quite frankly, to evolve. And certainly, you know, there's been more guidance issued by the Fed in the last few weeks around board oversight and some of the, you know, the roles of the board and the roles of the CRO. We manage our enterprise risk management framework, as you might expect, 3 lines of defense. I'm sure that term is familiar with you. But for us, what that means is the first line of defense. And I think about it as simply as this. If you generate the risk, your first line in that instance. And, you know, quite frankly, every employee at a large bank like ours, 260,000 odd, they all generate risk. You know, they may not be in a business line. They may be in a support function or operations center or legal, but you all manage, you know, you all can generate third-party risk, conduct risk, all sorts of different types of risk you can manage. But the primary risk for a bank like ours is generated by the front lines and by the businesses. And specifically, again, if you generate that risk, you own it. And by that, we mean you identify the risks, you monitor the risks, you manage them, you mitigate them where possible, you report on them, you escalate, and you're subject to the whole framework. And we've really, really pushed that in the last probably 2 or 3 years to say, as a front line, you really own that risk, not audit, not your legal partners, but you as a frontline manager. And that's really key, I think, in ensuring that the clarity of the roles and responsibilities. We, as an independent risk management function, I think of us simply as having 2 key roles. First of all, I report independently, even though I have an administrative reporting line to the CEO of the company. My primary reporting line is to the chair of the risk committee, and that, ensures some independence. And I noted that in the Fed guidelines, they are even providing guidance to create that independence even more by maybe even unlinking a CRO's compensation from the actual the performance of the company, meaning the revenue and the P&L of the company. So we'll see sort of how that plays out over the large banks. But really driving the regulators really driving for that independence and that very strong aligning with particularly with the board in general, but particularly the chair of the risk committee. But our 2 roles as second line is, the first one is to really create those frameworks and programs, policies, taxonomies, the rules of the road, if you like, that the company should be managing and thinking about their overall risk management. That's sort of the first role. The second role is the independent oversight, the review and challenge, and that's working with the businesses in their day-to-day activities, in their implementation of a new policy or a new framework to ensure that they're doing that fully integrated in a holistic way and really managing the risk. And then, of course, you have the third line, which is audit, which is broadly, largely an operational risk testing function with a preordained plan at the beginning of each year that comes in and does some testing around that. And of course, we're all subject to audit reviews, including independent risk management. There are multiple ways too in which we manage those risks and how we engage with the front line. And those can become, can just be in your sort of day-to-day activities, can be in the day-to-day engagement with the business. But importantly, we have a very strong, what we call risk and control governance that starts within all of the businesses and for the functions as well. Because as I mentioned, they do generate risk. And then that escalates up through the company to the top of the house risk committee, which I co-chair with the CEO of the company. And then we escalate into the risk committee and to the chair of the risk committee. So the board's role is really, sits across, it's truly an oversight role and sits across all of that governance, expects us to manage the risks on a daily basis, expects us to escalate the issues to them appropriately, expects the right level of detail, but not so much so that, they're just swamped with data and metrics. And that's actually quite a difficult balance to make sure that you're getting all of the key risks and issues, emerging risks, any challenges to the board appropriately, timely, but without too much minutia that they either don't understand it or are unable to really understand those risks. We've also got other governance, and I think we think about what we try to do is, of course, what to manage the risks by each of the businesses and then at the top of the house. But we also think about the risks in and of themselves. So we have risk committees that manage credit risk holistically for the entire company so that we understand decisions being made in this business, potential impacts here, and it all comes back to this risk appetite and how you allocate sort of the capital. Same with market risk, same with operational risk, compliance risk. And then we would also put governance around key items. And I think a couple of examples there might be the LIBOR transition, which I'm sure you're all familiar with, a major initiative that we have to get done by, depending on the timing, we're still aiming for the end of the year. But, that obviously requires a lot of risk management and a lot of governance around that. So that's broadly, but I think, the board, I would say that, I have very regular I have a very regular cadence with the chair of the risk committee, Maria Morris, and she and I will talk on a regular basis. We'll prepare for the risk committees. We'll debrief the risk committees. I'll escalate issues by calling her if they need to be timely. But that relationship is very, very important. That trust, the fact that Maria and I can talk through issues and challenges, and together we drive the agenda for the risk committee. So that relationship is very, very important as well. So maybe I'll just stop there. Hopefully, I answered that question.
Oh, well, very, very fully, I must say. It's quite an impressive organizational setup. The fact that your function is independent, and the fact that you have a direct line to the chair of the risk committee of the board.
Yes, yeah.
That's liberating for you, I'm sure.
Yes, it is. But let me just follow up on that. I am a very, very strong believer in independent risk management being part of the management team, right? So we're not supposed to be, truly a police function, right? Where, it has to be a strong partnership with the business. And, when I think about working with my team, really, I try to, it's really around trying to find a way to yes, rather than no, you can't do it. And I don't mean that we're saying yes to everything. I just mean that, if we're working through, whatever it is, a new product, a service, implementation of a program, whatever it is, we really should be coming at the problem by saying, what are the issues and concerns that we have? What are the sorts of things risk controls or mitigants that we would want to see in order to move forward? And I think that's really, really important. I think, historically, risk management functions have sort of been perceived as, sort of this, police function that is, really a challenge and a barrier, and it shouldn't be. We are there to really, strengthen really the safety and soundness of the decision making and the risk management, and finding ways to say yes, I think is important. And I also think it helps you articulate what the risks are and the challenges are. If you're able to say, here's what I'm worried about, here are the challenges, here are the sorts of things that we need to think about mitigating. And then that helps the business think through how they strengthen the risk management or strengthen the product or the service or whatever it is. So just want to make, even though we have that independence and it is liberating, as you say, Bob, I do think we still consider ourselves as part of that management team. So there's a balance there for sure.
Well, yeah, I'm glad you clarified that, because one of the hallmarks of our program is that the ERM function, helps management make informed risk-reward decisions.
Exactly.
So we're not there to be the people with a 20/20 hindsight, but
right.
people
That's exactly
to,
right.
as you described. So that's wonderful. The ERM program informs what types of decisions, for example, strategic planning, strategic and tactical decisions, transactions, or mitigation exclusively. I know you touched a bit about that, but if you can just give us some examples here.
Yeah, and I think this is the wonderful part of the job, to be quite frank. It informs everything, and it starts really in that strategic planning process. And it's sort of a chicken and egg thing. Does risk appetite inform strategic planning, or does strategic planning inform risk appetite? But I think it's a sort of a circular thing. And so it really starts there. And we have a very, in our enterprise, we call it our risk management framework, but in our enterprise risk management program, we have some very clear roles and responsibilities, activities and actions that need to occur as part of our strategic planning process. And it's through that at the top of the house. So it starts with the CEO and the operating committee, of which I'm a member, to really, understand what the strategic priorities of the company are. And then what are those risks, and how do we manage those risks, and what's our risk appetite? Because it's all very well to say, we're going to originate mortgages, as an example. We're going to allocate this amount of capital for our mortgage business. But what's our risk appetite around that? How do we want to allocate capital? And that kind of really has to happen at the top of the house, because we've got multiple businesses across multiple clients and customers. And that risk appetite and capital allocation is a really, really important part of that. And that also obviously includes not just the financial risks, but the non-financial risks. What kinds of operational risks does this create? We think about, all of the banks have gone through this as they've improved their infrastructure, their technology, their operational. Those are strategic priorities to improve your infrastructure as it relates to how you do business. But there is operational risk that's created in the interim, and as you build that infrastructure, or if you move from this to sort of more of a digital platform, it creates operational risk. And what's our appetite to do that? So it's really it's really hard to sort of pull it all apart. It's so integrated into the decision making. So it starts there, and then as you push that down into the businesses, you go through that exercise again. So you've got the enterprise risk appetite, you've got the capital allocation, optimized across the businesses, and then you do the same exercise throughout the businesses. So that's sort of really, if you think about the tops down. And then, so I would say everything from a strategic planning perspective, but then on a day-to-day basis, it's really managing the deal flows, the transactional type things, the tactical. I would say, some of the things that we're preparing for, like LIBOR transition, is both a strategic priority because it's a non-negotiable, but it's also tactical within the businesses and in terms of how we solve that. So we have risk management engaged, all the way through, the different layers, both tops down and bottoms up, as part of our enterprise risk management program. I think a great example was last year, as we were all managing through the impacts of the pandemic. There were a lot of decisions and a lot of things that needed to be adjusted, a lot of policies that we had to review as we shifted everyone to work from home, as we provided customers accommodations, etc. Those are all in the moment tactical things, and risk management, and we pulled on all of the tools that we have out there, whether it was our risk appetite, whether it was our enterprise risk identification program, whether it was our metrics, our reporting, our escalations, exceptions. You think about all of the things that make up an enterprise risk management program. We pulled on all of those levers last year as we managed through the pandemic. So that's a great example of how we integrated it. And then if you flip back up to something perhaps that's more strategic as climate change, and as we're thinking about, and hopefully we'll talk some more about that, but as we're thinking about some of those things, again, it integrates into that enterprise risk management framework. It doesn't change that framework at all. It gives you the tools and the programs by which you manage those risks, you evolve your thinking. And climate change is a great example, because there's very tactical, in the moment types of things that you're managing today versus the more strategic. What do we do? What are the challenges? What are the opportunities over the next 10, 20, 30 years? And it's really thinking about those kinds of horizons. So it's just so integrated into all of our decision making, and that's why I love this job, because you really get to see that whole decision making process, the whole end to end of the company, and all of its planning.
That's great, and it's great to see risk management being integrated into all kinds of decisions. And I'm glad you mentioned the LIBOR transition, because and I'm glad that you mentioned governance around that, which is, I guess, a great thing to do, so that who's making the decision, who owns what, and
Exactly.
what the expected outcomes are. So hopefully that transition is not going to be disruptive to institutions or to the market.
Bob, if I could interrupt you, I think one of the key things about risk management is being prepared, right? There's no substitute for preparedness. And I think LIBOR transition is exactly that. Those that are more prepared for this will be able to manage it. And we've been planning around that particular topic now for as long as I've been at the company. So, 3 years. And it's a great example of something that cuts across all of the risks. And quite frankly, I think one of the biggest risks for that transition is reputation risk, because, sophisticated customers, Wells Fargo is one of the biggest originators of LIBOR-based products. So, it cuts across all our customers and all our businesses. But if you think about, you think about your commercial clients, your sophisticated investors. We'll manage through that with them. A lot of contract type negotiations and updating and that. But when you think about the consumers, you could walk out onto a busy street, although we don't have busy streets at the moment. But in normal times, when you have a busy street to walk out on, and ask 100 people what LIBOR is, they wouldn't know. But they have a mortgage, they have a credit card, they have products that are based off LIBOR, and suddenly, their payment changes, or they don't understand why the rate's changing. That's huge reputational risk when you think about it from the consumer perspective. So sorry to jump in there, but it's just such a great example of something that manages across a whole suite of risk, operational, clearly, the technology changes, the contract changes, but a really, really important topic around being prepared and doing the work.
I couldn't agree with you more. Thank you for enhancing that answer. In terms of successes of your ERM program, if you could share some of those, and in terms of, for example, what benefits have accrued to the enterprise due to ERM.
Yeah, it's a great example or a great question. I would say we are still maturing our risk management framework, but it's one of the biggest things I would say about what is the benefit is the clarity of roles and responsibilities. And I think if you could have everything else right, you could have all these programs in place and all your good reporting and great data and great infrastructure, but if you don't have clarity of roles and responsibilities, then all sorts of things fall through the cracks. And someone says, well, I thought they had it. Well, I thought it was their responsibility, they're accountable. And and that, particularly in some of the environments that we've been managing through over the last couple of years, it's so important. So I would say our biggest success is really now people understanding their roles and responsibilities. Now, does everybody in the organization all the way down really understand it? Probably not. But the people that are making the decisions understand what their accountabilities. Our performance management framework is, again, as another integrated point into the risk management, very, very important. And we have it's really a knockout sort of risk overlay. It's how well did you manage your risks? And we have some very clear guidance and definitions around that. And that's part of your performance management at the end of the year. And if you didn't, meet those expectations, then it has an impact on your performance management and your compensation. So though all those things really help drive the right culture and the roles and responsibilities. But I would say that's probably one of the biggest successes of the program is really, we have very, very detailed and defined roles and responsibilities. And it, like I said up front, it lands with the front line really owning the risk and understanding what that means. So I think that's probably one of the biggest things. A couple other things I would mention is when you have a good, I think about the enterprise risk management framework as sort of your tool belt. You have all these tools on your tool belt by which you manage the risk, but they all work together. And your tool belt would be useless if it only had a hammer, or be useless if it only had a screwdriver. You have all of these different tools that help you understand your risk, help you monitor it, help you manage it. We have to take risk. We're not risk-free. So really understanding the risk you're taking, monitoring it, making adjustments when things aren't, performing or actually, playing out as you might have hoped or expected. All of those, create this framework. And I think having that in place really helps us drive stronger, more holistic decision making, which when you think about, say, last year when we were adapting to a pandemic, or we want to lean into a competition around, a digital product or a service, you can do that so much more quickly, so much more nimbly if you have all of that strong decision making in place and that risk management in place. And so I think it's a differentiator, right? When you have a strong enterprise risk management program, it's absolutely a differentiator because you are able to be more nimble. You are able to, we're not always going to make the right decisions either. And it's as we make decisions, we monitor it. It doesn't go the way we expect. We have an exit plan. We have a door, and so it's understanding when we hit those triggers to be able to say, hey, this is, the risk is starting to get, above what we expected, or we don't understand it. and it allows us to make those adjustments and pull back. And I just think those are some of the biggest successes. Now, we're still maturing into that for sure, as are, you know, all of the large banks. But I think those are the key things. And honestly, I think we absolutely saw the benefits of that last year, without a doubt. Our decision-making process, our understanding of the risk, our ability to make good decisions on remember back in this time last year, we did not have a lot of information around the virus, what it meant, who could get infected, what it could, you know, there was a lot of anxiety overlaid on that as well. And we were able to make, as did the industry, honestly, it's not just a Wells Fargo thing, but we were able to make, you know, really good decisions in the moment, understand when those decisions needed to be adjusted as we got more information. And I think last year was a great example of the financial services industry really managing. I mean, it's massive, essentially we didn't move everyone, but probably 2/3 of our workforce to a work from home environment is huge. And it went pretty much without major issue. Even programs like the Payment Protection Program, if you were following that, you know that the guidelines change daily, you know, and it was really managing to a moving target. And again, our decision-making, our risk management program was key to really assessing the risks that we wanted, that, you know, within our risk appetite, because there was lots of ability to make different decisions, particularly around things like financial crimes and know your customer. All of that was very much very difficult in the moment for last year. But, you know, and again, it wasn't without mistake and without challenge, but generally as an industry, got that money out to the customers. Even simple things like the stimulus, you know, the checks, those land in customer accounts. If the customer's overdrawn, how do we make sure we protect that money, right? Because if they get a check for $600 or whatever it is, that lands in an account that's overdrawn, you want to make sure that customers, they still have access to that. And in under our normal rules of overdrafts and things, that would be harder to do. So just all of those things. And then, you know, we've talked about it a couple of times, take something else like LIBOR transition. I think that's been a great example of our enterprise risk management program really preparing us for what is I call it Y2K on steroids. I think it's, and many of you aren't old enough probably to remember the Y2K, but there was a lot of preparation into that. And I do think the LIBOR transition is really that, you know, to the nth degree. So again, we'll see how well that goes, but I feel very confident that we're well prepared. Wells Fargo is well prepared for that.
That's great. Someone is going to be doing a case study of how the industry or specific institutions manage through the crisis. And I remember in the early years of stress testing, oftentimes institutions failed to pass, and the key factor was governance.
Yes.
That people did not know their responsibilities, and there was a disconnect there, and the regulators just were not comfortable to issue a pass. So that's really great. A great system and a great way of doing business and addressing new risks or new situations. All right. Let's see. You know, a lot of organizations are revamping the risk function. They've been doing that, I guess, since the great financial crisis.
Mm-hmm.
And now with the pandemic, that adds another layer of uncertainty. Is this going to be a 1 in 100 years type of thing, or is it going to be something more frequent given the number of pathogens, millions, hundreds of thousands, not millions, but over 1 million pathogens that could cause pandemics. So a lot of organizations are going through this. What are the key skills and experiences you look for as you build your team?
Really a terrific question, and again, something that's evolving. You know, if you wound the clock back, you know, 10, 15 years, so very different than what we look for today. But if I think about I'll talk about technical sort of experiences and skills, but, you know, to me, some of the key things are really around the leadership and the management type skills that we look for, or I look for. I think probably the number one for me is intellectual curiosity. And I don't just mean, you know, learn new things and really understand what things are changing and stay current, which is important. But it's really around, you know, your day-to-day interactions. You know, a business comes to you with a product and they describe it. You know, dig down, ask that first question, that second question, that third question, really get into the details and understand it. And I think, you know, that's, you know, don't be afraid to ask that question that might seem maybe that you're nervous of asking because it seems basic, but often those questions don't get asked, and you know, and something glides through and it's like, well, how did it get this far? Because nobody asked a simple question. And so I really look for that. That all of my leadership team now are very much into the details, and I get that. You know, when I sit with them and we meet regularly, I have you know, my risk operating committee that I hold with all of my leadership team. I run business reviews with them, and where we really get into the detail, and they are able to answer my first, second, third question. So I think that's really critical, is that intellectual curiosity. Ask those questions. So I think that's you know, that's probably some of the key things. Always come prepared. So do your homework. Have a point of view. I think it's really important to do your homework, understand, ask those questions, and then have a point of view and be prepared to defend it. So I really, those things are really, but you know, it doesn't mean whether you're a credit risk, your market risk, your op risk, technology risk, whatever it is. I think that's really important. We touched on it earlier. I do look for some business experience. It's not a non-negotiable, but it's really a helpful thing to have people that have spent time in the business. And my chief credit officer was running a large business in the commercial bank for a while, very respected leader. And she has brought such a different set of perspectives to the table in terms of how she solves problems, how she asks those questions, the balance that you get. You know, we talked about, you know, finding a way to say yes. Really understanding the risk, but trying to manage, and I think those things are really, and I think, you know, those that haven't spent time in a business have really appreciated her insight. So I think that's really key. And then if I get to some of the technical, you know, the technical experience, clearly things like credit risk or market risk, you need to learn them. You need to roll up your sleeves. You need to get into some deals and understand and, you know, make a credit decision and perhaps watch it go wrong and manage, you know, and sort of manage through it. There's really no substitute there for some of the experiences that you get. But I would say, you know, some of the things now is the digital landscape, the technology, things like cybersecurity, you know, starting to look for, and I have a team of 250 or so people that help oversee some of my information security, technology, cyber, all those kinds of things. And many of them have technology backgrounds. So they've been in a technology group for a while. And, you know, you kind of need that. Those are very specific experiences that you sort of need to have and really need to, you know, same with some of the compliance functions, you know, understanding the Volcker rule and financial crimes. They're very unique expertise. Which you know that we definitely look for, but that doesn't mean to say that as you know, as people that are, you know, coming out of college or earlier in their career, you know, we have a lot of programs, a lot of credit training programs, technology training programs. There's a lot of ways in which you can come in to an organization like ours and learn those. So then it comes back to your intellectual curiosity, your work ethic, your you know, your preparedness and looking at those sorts of things. And then, you know, finally, I would say, because it's one of the things where I've really enjoyed in my career is take a risk once in a while, move yourself out of your comfort zone. And I do like to see people that are willing to do that. So that's sometimes harder to do, and you need kind of mentorship and sponsorship to do that often. But you know, I've had a great opportunity to, you know, I had a background in market risk and treasury, and someone took a risk on me and said, hey, come join the investment portfolio business and run a trading book and things like that, you know, and it took me entirely out of my comfort zone. And so, it's good to see that as well, people that are willing to sort of take a little bit of a risk in their careers, and because you always learn something from it. I don't think there's a real big downside. So those are just sort of in a nutshell. But when you think, you said it, Bob, earlier, when you think about the risks that we manage, the broad set of risks, there is so much and so much to learn. And certainly my experience historically has been more financial risk driven, but having now managed and been a CRO through the financial cycle of the 2008 2009, and certainly in this last year, I've learned a lot more about operational risk and compliance risk, and and then you become part of the team that evolves it and rethinks it, and so I would say those are some of the key things.
That's wonderful, and of course people have to feel safe to be able to express their point of view.
Yes.
And I'm sure that's encouraged in that scheme of things.
Yes.
That's wonderful. In terms of, I know you alluded to this in many of the answers that you have articulated. What do you find most rewarding about your role as CRO?
There is so many. I mean, the sorts of opportunities and career paths that you can take are so vast these days. And I think because of the role of the CRO today, there's much more ability to be able to move back and forth between a business into risk. I think that that mobility is much increased. So there's, I always say to people, if you don't think you're going to be a risk professional, that's going to be your path, absolutely consider some time in risk management, because it will make you a better business leader. The best business leaders that I've worked, the best CEOs that I've worked with have been risk managers in their past, without question. And so I would, that I think is, one of the rewarding things about this. But I would say probably the number one thing for me, as a CRO, you really get to see end to end how a company works, how to be part of that strategic planning, to be part of that risk appetite discussion. And there's probably not another role like that, right? Unless you're the absolute CEO of the company. But if you think about, our company, we have 5 business CEOs. They obviously are involved in discussions and strategic planning, but largely on a day-to-day basis, they're managing their business, whether it's the investment bank or the consumer lending business. Whereas in my role, I'm able to, really get to see all of that continuously and how it fits together and inform decisions we're making in this business with lessons learned or best practices in another business. And so that's what I love about it, is just being able to, to see the company end to end, manage the risk and help manage the risk holistically. And that has just been terrifically rewarding. And, I've over the years, I came up, I have a mathematical background, but I came up through market risk and credit risk, which tend to be a bit more quantitative, and have had the opportunity to really learn technology and technology risk and cyber and operational risk and compliance. And it's really been, for someone, if you are intellectually curious, it's really rewarding. And there's not a headline in the newspaper that doesn't impact our business, not a single headline. And so, having, reading that, staying current, is just really, really rewarding. And then, of course, with a large company like ours, the ability to work in, I've lived and worked in London, in Singapore, in New York, in San Francisco, and it's just been personally, just been a wonderful thing to live in different cultures, different countries. And not everybody wants to do that or has the ability to do that, but it is clearly an option in a role like this as well.
This is amazing. You talked about intellectual curiosity again, and one of the ways that we engender that in our students is by talking about current events.
Yes.
They're forced to think of current events a bit differently than they used to.
Yes.
because now they have frameworks, they have tools that they use to really try to understand them.
Yes.
And I find that that creates a curiosity, an inherent curiosity in what's happening. You cannot be in risk and be asked a question about an event that happened and that you are not informed about it, that you have
That's right.
no opinion about it.
Yeah,
So
that's exactly right.
yes, so that's amazing. Great. What sort of advice might you give to students aspiring to a successful career in risk or ERM?
Send me your resume. No, I'm just kidding. We probably touched on a lot of them. I think people often ask me, what was your career plan? How did you plan your path? And I didn't. I really didn't. I think you should, live in the moment that you're in and make the most out of whatever role you're in. Learn as much as you can. Because it doesn't matter, even if you end up going and taking a role that, really you say, well, that didn't really float my boat and, that wasn't really for me. You will always learn something. You will always grow as a manager and as a leader, and you'll be surprised how much you take from that experience into, other roles and jobs that you've had. And I found that continuously through my career, that I draw on experiences or expertise that in roles that I didn't love particularly, weren't the ideal role for me. But I'll take when I was in Treasury, I quite enjoyed being in the Treasury function, and it actually tapped on a lot. We were doing mortgage prepay models, which is very quantitative, and so that sort of really was stimulating from my perspective, given my background. But what I learned in that role around treasury and capital and liquidity and how a bank works, how it makes money, what the risks are in the steepening yield curve, flattening yield, all those things, it was like I learned it. But now that I'm the CRO, it really has enhanced my thinking and decision making around those sorts of things. So I just put that out there as an example of, you would be surprised, even in a role that you would stack rank as, that one was the least interest to me, you will learn something. So that's what I always tell people is, don't be afraid to take a leap. Don't be afraid. Don't certainly do your homework about a new role or whatever it is, but don't overthink it, because I do think there's little downside risk if you yourself make the most of it. But, the single piece of advice is, make the most of that role, learn as much as you can, ask the questions, meet the people. I mean, the networking and, you'd be, again, I can't even tell you how many times someone reaches out to me or I come across them. They join Wells Fargo and it's, oh, crikey, I worked with you like 20 years ago at blah, blah, blah. Those relationships and networks are really, really important too. And so don't underestimate, that. And I think the strength of any networking relationship is on the work that you do. You can, you can go have dinner, you go play golf, whatever, but really I think my strongest relationships have come out of when we've worked together and we've tackled something. And, I have lots of good examples, but I have a colleague of mine at my previous organization who I'm still in touch with, but we were managing out of the mortgage crisis, repurchase reserves and credit loss forecasts and working with the mortgage agencies like Fannie and Freddie. And we would be holed up in our office, in her office or my office, for hours on end. And it really built a very, very strong relationship. And it's in those moments, in those times where you're working hard to solve a problem, you've got complete trust with those partners that you build these really strong relationships. And so I would say, as you're starting your careers, those things are really, really important. And those people, it's a small industry, and it's, so build those relationships, manage those relationships, but just go into it with all you got. And like I said, whether it's a risk role, it's a business role, it's you go into a quantitative modeling role, there's so much out there to learn and so many opportunities. And like I said, in today's environment in risk management, you could take any path and be a great risk manager. I really believe that. Send me your resume. I'm always looking for good talent. Columbia is a great school.
All right, great, great. We will, we've been in touch with your people.
I know.
Yes, yes. So we are very happy about that. Chat has been very, very helpful. So that's really amazing. I mean, I feel very an affinity to the comments that you made. Oftentimes, only in retrospect, you find out how useful the past experience has been in getting you to where you are now. Maybe at that time you didn't appreciate it, but that's very true. As
Right.
you are curious, and as long as you make the best of any situation, that you can only benefit from that process. Wells Fargo did very, very well during the great financial crisis. It purchased Wachovia. I mean, that was a big deal. It showed that it had vision. That was a great transaction. Wachovia, a great shop for many years with a lot of expertise. That now became Wells Fargo's property, which is, banks in the East didn't much like Wells Fargo coming into this market, but Wells Fargo, I think that was a big strategic move there that paid off very, very well. We have some questions here, I see, and if I may look at, let's see. Okay, yeah, we have a question about the regulatory expectations around ESG, and how are you integrating ESG considerations in Wells Fargo's ERM framework?
It is a very topical question, and I'll go back to saying something I said before. If you have the right risk management framework in place, or an enterprise risk management framework in place, you should be able to absorb any of these things. And climate change is no different. Climate change is not a risk, it's an outcome, or it's an event that creates risks. And so, climate change can create every type of risk: credit, market, technology risk, reputation risk, compliance risk. And so it really cuts across. And so what we're doing is working through our framework, through all of the elements of our framework, starting with the risk appetite, and all the way through our data, our monitoring, our metrics, enterprise risk identification, our risk control self-assessment. All of these things are impacted by climate change. And so I would say it's extraordinarily nascent at the moment. None of the US agencies have and are ready, I believe, to issue any sort of formal guidance, but they are very, very interested in what we're doing and how we're thinking about it. We, as have all of the large banks, and ours was just recently, a couple of weeks ago, issued our commitments around climate change and social responsibility. And that in and of itself is work, and it's getting the data, getting the metrics, ensuring our disclosure is appropriate. And in many cases, we're reliant on our customers and clients too to provide that information. So, we're working through all of that. As a sidebar, we're thinking through how we fully integrate the social governance and climate change, whatever it is, into our risk management framework. And what I found actually is it's actually relatively, I don't want to be careful how I say this. It's not, the topic itself is not straightforward, but integrating this into our risk management framework is relatively straightforward. Where the challenges come is the data. We don't have great data around this yet. And even we spent a couple of hours last week talking about scenario analysis, which is a tool that we can use to really help inform our strategic planning and our risk appetite. But what's your time frame? Is it 10 years? Is it 20 years? Is it 50 years? What do we think is even going to be the case in 10, 20, 50 years? So, managing those kinds of things, the actual implementation is very complicated. We're certainly looking to our colleagues in Europe, who are a little bit, even Asia actually, but particularly Europe, are a little bit more forward in their thinking. The regulatory agencies there have issued a little bit more guidance. They have, so we're certainly leveraging. We certainly don't want to reinvent the wheel, but I would say generally it's very nascent. Social responsibility in general, it's things like do you finance, oil pipelines or cannabis manufacturers. They're all very, very sticky things to think of. But again, they integrate very, very well into the risk management framework, into that sort of holistic set of steps and tools that we use. But the decision making makes it quite hard. And one example around cannabis is, many states, I've lost count now, I think it's at least 30 plus states that have legalized cannabis, at least medically. But at the federal level, it's still, still illegal. And because we're a federally regulated bank, it creates a lot of problems for us. And, we're not the only bank. So managing through those kinds of decisions, but we definitely use the risk management framework to really inform those decisions and drive that decision making. And I'll tell you, a lot of time it ultimately comes down to reputation risk. What sort of leap of faith do we want to take around some of these things, and what reputation risk can it create? I think the climate change one is, we could probably spend a whole afternoon easily talking about that. It just has so many ramifications, right from the the top of the house to the strategic planning, all the way down to, day to day, how you finance electric vehicles, or where you what happens when they redraw flood zones in terms of your mortgage originations, so commercial loans. So very, very much. So in short, I would say it's still very early in its evolution, but it is quickly gathering steam. It is clearly a hot topic for the new administration. So I think we'll see a lot of new thinking and perhaps even guidelines, but we're probably 2-3 years out, I think, from getting anything formal from our regulators.
Yeah, I'm sure we are going to have constant reminders of climate change, like we had last year in California, or the floods.
Texas storm, yeah.
Right. There's a question here about control functions and the type of risks they generate.
So that sounds like a bit more elaboration on
okay, I would like to ask this question.
I think the question is asking me to elaborate. Is that right?
To elaborate, yes, briefly, because I have a couple of more questions.
Yep. So let's just take risk as a control function. So I have 11,000 people, all of whom every day create risk for me, right? Through their interactions, through their conduct, etc. So obviously I manage conduct risk. We hire third parties. I have people that help us with modeling, consultants. We have third parties for some of our technology solutions. All of those things create those types of risks. We have compliance. Do my staff adhere to the personal trading, the investment policy, as an example? Those licensed employees, are they taking their exams and relicensing appropriately? All of those are compliance issues. Operational risk issues. We build models. We create loss forecasts. What happens if our tools, our models, our spreadsheets create that's operational risk. So think of those sorts of things. We don't generate credit. I mean, I don't originate loans or trade books, but you think about particularly the non-financial risks, we can generate quite a lot. And I run my own risk and control governance to manage those.
Great, thank you. That's a great response. This touches on the discussion that you had before on ESG. So the question is, it's a statement that Wells Fargo recently adopted a net zero financing pledge. What is the biggest challenge to achieve this pledge? And then in terms of through 2018, Wells Fargo Environmental and Social Risk Management Report that Wells put a lot of focus on ESRM due diligence. However, how will you input environmental and social risk management metrics to the product design process? There's a specific sort of
Yeah.
question, but you know, a brief answer would be appreciated.
Yeah. Yes, of course. And I know we're right at time here. I would say on our announcement last week, I think that the biggest challenge that will be data, is getting the data from, you know, internally, externally, from our clients to make sure that, you know, first of all, defining it and then really getting the data. That will be the biggest challenge. Is not that, you know, if we have that, I think, you know, we will be able to meet that goal, but just really being able to get the data is the single biggest challenge. And then, you know, I think I'm not sure I fully understood the second part of the question, but, you know, I think the enterprise risk management, again, you know, the framework is appropriate. It's fairly straightforward to integrate these things into the framework, but the implementation of it is the difficult thing. And again, with things like ESG is around our data, is around the infrastructure that we need to build. And, you know, quite frankly, probably the biggest challenge, as I mentioned before, is probably sort of the reputational risk around those things, because some of these issues are so polarizing that reputation risk really becomes probably the top risk.
Right, exactly. So, and one question about return on investment or VRM is, have you any, you know, calculation on that, or is it qualitative in nature?
No, we have, well, it would be qualitative and quantitative, but I think we can, you know, we can clearly demonstrate the return on investment of an enterprise risk management program. And, you know, you know, we'll continue to improve that. I mean, I think when you're in the build mode, you have a lot of, you know, you have a lot of people building it, a lot of time spent on it. As you move more into a BAU, you know, that return on investment definitely increases. And I actually think that's where it, you know, that's where it becomes a differentiator, when it becomes part of the culture, part of the DNA. You know, it's you know, you don't think about putting a seatbelt on when you get into a car. You won't think, you know, ultimately when you get into a mature risk function, it's just so much part of the DNA that it becomes a differentiator, and then your return on investment really increases. So we do have quantitative and qualitative metrics around that.
And of course, it has an impact on the stock price, the share price.
Absolutely, there's lots of metrics that you can look at.
Which is a huge driver.
Yep.
All right. Well, Mandy, thank you so much. You've been so informative, and our students and we appreciate that very much. I'll turn it over to Jay to say the final word, and thank you so much.
Thank you again for the opportunity. I really appreciate it. Bye-bye.
Thank you.
Thank you, everybody, for joining our event, and have a good day, and we'll see you at the next one. Goodbye.
Thank you.